Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending September 30th, 2022. Market indexes, well, the TSX was flat and the American S&P 500, Nasdaq, Dow Jones, and Russell 2000 all were down. Oil was up barely for the week and gold was up less than 1%. On Thursday, we got Canadian GDP numbers for July up 0.1% for the month, with a small loss expected for July. However, Bank of Canada estimate for August showed a 0% increase, indicating the economy is losing steam. The higher interest rates affected all aspects of the economy negatively, including lower job vacancies. The S&P 500 is back down to a bear market to the June lows and below from the recent highs. The bond market has, due to the rising interest rates, become a viable alternative to stocks because the short term, no risk US government bonds are now paying 4% or more, which is better than most dividend payers in the US, causing some of the stock market pullbacks. Bonds are becoming investable again, especially the short term ones, which pay a nice interest on any new money. There is some optimism for Q4, which is the end of the year, because of quote unquote seller fatigue. The importance of being invested is underlined in that by the time we start to pull out of the possible recession, the market has long ago started recovering as it is forward looking. As soon as whatever has caused the market even begins to improve, the market is over it. In this case, it is the inflation. So when we get a couple of downtrending readings in inflation and the central bank stop raising interest rates, the markets will take off. The yield curve inversion in Canada is still a concern since it can signal a recession. This is where shorter term bonds have higher yield than the longer term bonds. The Canadian economy does appear to be slowing in the latter half of 2022, even if it is not apparent in the GDP numbers yet. There's more thinking about an early 2023 recession and possibly a worldwide recession. Markets are likely to bottom once inflation stops increasing, following several monthly inflation readings that are trending downwards, and the central bank stop increasing interest rates or possibly cut them. Q3 earnings are still decent, increasing revenues and profits at least in high single digits, and there is no hardcore recession with high unemployment on the horizon. If Q3 earnings warnings come out more significantly, the market could take another downturn and then bottom once the earnings revision stops. The other variables are the job market, where the thinking is the rate hikes will continue until the job market starts to weaken. The best case scenario for us is that by the end of the year, there's a weak recession and inflation is around 4 or 5%. Turning to more specific news, the Bank of Nova Scotia CEO is retiring, and a new CEO who has been on the Scotia board but is otherwise an outsider is being brought in. Scott Thompson is the current CEO of Finning, a reseller of construction equipment, and has no experience in banking, but does know business in Latin America, which has been causing the bank problems, but makes Bank of Nova Scotia among the Canadian banks to have exposure there. Scott is presumably being brought in to shake up the underperforming compared to other Canadian banks institution and move forward. The US dollar is strong these days, and it's strong because people flock to safety of a reserve currency and the US interest rate hikes for higher returns. This is costing global companies revenue if their revenues are in weaker foreign currencies. The US consumer confidence comes in at the best level since April. The US weekly jobless claims fall to the lowest level since April as well. On Friday, the US Fed key inflation measure, the core PCE price index, was reported and climbed 0.6% in August, slightly higher than the 0.5% estimate, making people think a 0.75% rate hike is coming up next for the US Fed, while a half a percent seemed likely until now. The report caused a small sell off in the US on Friday. Analyst optimism for Q3 earnings is waning, with worries about profit margins. Mid-single digit profit growth would be good, as I had said before. If profits slip in Q3, another leg down lower in the markets is quite possible. The World Bank has downgraded China's expected GDP growth for 2023 to 2.8%. The type of growth they have had in the last 2 decades could not be sustained and will become more reasonable going forward. Chinese real estate has been going down for a long time, and China is cutting interest rates in trying to help the real estate and mortgage markets. Predictions for the coming holiday season are coming in negative. Retailers will likely struggle because of the inflation the consumers are facing, causing negative sentiment, and because of the still high inventories, retailers may be forced to discount their prices, hurting the profit margins. Inflation is also increasing the retailer's costs related to the retailer's heavy reliance on wage labor. 80% of Canadian mortgages are fixed, so they will not be affected by interest rate hikes for a while. In the US, mortgage rates have hit 7% this past week. The next Bank of Canada interest rate meeting is October 26th, and the bond market is thinking a half a percent rate hike. Turning to Europe, the UK bond markets and the pound went into freefall this week as investors balked at the new government's fiscal policy announcements. The Bank of England on Wednesday was forced to intervene in the bond market with a temporary purchase program, as the capitulation of long-dated gilt prices, which are government bonds, threatened pension funds and mortgages, posing what the central bank deemed a material risk to financial stability. UK stock markets obviously sold off. This was related to the strength of the US dollar caused by higher US interest rates and the Fed selling bonds as quantitative tightening. The stronger US dollar caused the UK pound to weaken and to be on par, which hasn't happened for decades. And to prop up the pound, the UK central bank needs to increase interest rates, which becomes bad news for all the borrowing the UK government wants to do. The strength of the US dollar has caused all sorts of issues throughout the world because so many things are priced in US dollars, such as oil and commodities, making them more expensive for other nations. Even worse, companies like Canadian Airlines get their revenues in Canadian dollars for the most part, but pay for their fuel in US dollars, so the USD strength harms them especially. Turning to next week, the companies reporting are Tilray next week on Thursday. Otherwise, the market is waiting with bated breath for the Q3 earnings. Looking at economic events next week, Monday is the manufacturing data from both sides of the border to indicate industrial and business health in the economy. Wednesday, mortgages in the US are going to indicate real estate transactions as well as US imports and exports, business activity, and US oil inventories. Friday is the important US payrolls and unemployment on both sides of the border, where Canada is expecting a 5.4% for September, as it is currently. An OPEC meeting starts October 5th next week. The expected cut to production by 1 million barrels per day is pushing up oil prices. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.